going with March trends. Now, today's a big day because we're going to be talking about things that you might not have heard of. So let's unpack what the real estate top 5 trends are as of March in 2026. Now, starting with our first one, this is going to be something most people don't understand. It's an acronym name, so let's unpack it and start right from the top. 5 trends in CRE real estate. First thing that we're going to talk about is the rise of flexible office spaces. So what's happening in today's market is office buildings, especially in urban settings, they've gotten popularized again. But a lot of the sector is still feeling and licking the wounds of what COVID had destructed. And it repositioned a lot in commercial real estate, and office buildings had to become flexible. So now what we're seeing is an office building transforming into multiple different things. Maybe they knock the entire building down and they build something brand new. Maybe they condominiumize and retrofit the interior of the buildings to fit more of a marketplace for residential housing. Maybe they take the entire building and they gut it and they make it a 40-foot warehouse and they add loading docks and doors because it's in a hub of commercial industrial. Or maybe all of a sudden that big glass office turns into a restaurant or event space. These things are happening all across the board. So when you start seeing the rise of flexible office space, don't be surprised because in that mix, people have to rejuvenate. And in our society, a lot of the office buildings in the 80s and 90s, when everyone was going through there, has changed in the marketplace. We're becoming as effective in technology, and that technology is improving the business efficiencies. What does that come into? You're going to see a lot of people working from home and working from different sectors. And we've gotten away from that post-COVID. And I'm a believer of working in an office setting. I think you get the most production. So finding where you can see opportunity in offices would be where I encourage you. Find the rise of office flex space. You can turn it into something new. People understand that it has to be done. It's a matter of what. And towns are willing to reposition this because they don't want to see office buildings just sitting vacant. It's a liability, and it's also a concern for everybody around the neighborhood. Flexible office spaces, they change with it. That's what we'll start to dive into today. ESG's integration becomes non-negotiable. What's ESGs? ESGs are simply environmental, social, and government. What does that look like? They're non-negotiables with developments and the way that buildings are repositioning, so to speak, from flex office to industrial, multifamily, and developments. Technology-driven property management, huge trend right now. What we're finding is efficiency skyrockets when you can use technology in your property management. So what we're finding is that instead of having 3, 4, 5 different administrators or property managers, you can have 1 or 2 that's utilizing the AI systems, an online platform, and that's going to give you a bigger success ratio and a better payroll. Because with more efficiency and less hiring, and that could be something that increases your business. Now, over time, we want to grow businesses. So our goal is to get that to a point where you grow your business and you hire more utilizing the AI systems. Next is our demographic shifts, redefining retail and residential. What we're seeing right now is huge market trends where if you're looking at it from a perspective of a giant mall, maybe the mall is adding housing. In our area in Bergen County, Paramus Park Mall, Garden State Mall, they're all putting housing, improving apartments, and living on those same sectors of land that can then incorporate. You can walk through, you could take your car across town, and it's literally in the mall. Those things are being redeveloped and repositioned. So huge opportunities and demographic shifts because people want them. You don't want to have to drive 15 to 30 minutes to go 2 miles in our area. If you're in the setting where you can just go, receive, walk, you're probably going to get a better value. That's what we're finding developers everywhere in between jumping into because it's a good, safe product for them to put their asset in, get their return, and get out. The last is the investment capital. Guys, a lot of capital is relocating all across the country, not just from New Jersey out or New Jersey in, everywhere. Those states look like California and New York. With things that are going on right now, it's no wonder that everyone wants to get out. How could you possibly see all of those benefits from those states and value it higher than your own governing of your own business and what you're doing to grow grow that and pay employees and just grow everything in general in their communities. Instead of taking, it's the give method. So we're gonna explore what that looks like and the trend that's it. So diving in, first thing is office buildings. A lot of them are defaulting. Large office buildings that are repositioned into new products become something that's valuable. But when they're sitting there, property owners just don't have any income, what happens? People default. All of a sudden, what becomes an asset that once was is now a new opportunity for somebody else. So if you're new to real estate, understand, you don't have to be 20 years ago. You could be right now and still win. Just have to right formula, right success strategies, and a proven model. Now, what does that mean for you guys in general? It means that buildings are unable to meet their financial obligations or property loans maturity-wise coming due. So they have to sell. We were put in a position where we have to figure out what we're doing with a property that we have. And it's either you refinance the loan, you sell the building, or you default on it. Now, obviously, we want it to continue on. So there's ways that you refinance it and keep it going. But what if you're a property owner that's at the end of its life? You don't want to have that refinance. You don't want to default. Your other option is to sell. So what we're seeing is a huge opportunity in distressed markets for commercial, and also the opportunity to just sell retail commercial. Because that $1 to $10 million market that we focus on with ERG, we do our price per square foot, our income and expense, and our dirt to dollars, and our 3-step process valuation system to make sure that we bunker these homeowners, these property owners, and these commercial development sites into the max value, and we deliver that with clarity. So that's a big opportunity. Banking sector is poised to become the largest owner of real estate in America as these defaults are untold. We don't know. Get your opportunity. If you're a property owner, think. You have 3 options. Default the loan, refinance, or sell. Figure that out. Hire us to make sure that you get the top valuation. We'll be able to make sure that we untap what option is best for you. Trend number 2, billions in CRE loans are coming due, guys, and you don't even know what that opportunity looks like. Because as I just explained, there's really 3 options. So what we're seeing is maturing loan waves. As 25 and 26 come due from COVID, a lot of properties have to be sold. Now, what was occupied at 100% may be occupied at 40 or 50% now. So your income and expense valuation is shitty, it's sucky, right? But the price per square foot's risen. So maybe that industrial property that you have that you don't really think is valuable is really valuable. Because based on what the market is and based on your perception of it, they're not in line. That's what we're finding a lot of people dig into and untapping dollars from those industrial properties and those development land loans. Now, moving ahead, increased borrowing costs. Guys, this has been across the board and it's on headlines everywhere. If we had mortgage rates that are going up, what do you think happens in commercial? They go even higher. And that's the same theory with commercial construction. When we were going back a couple years, rates were 8-9% for construction. Those are significantly lopsided and kind of screwball everything up within a development. So that's going to be a pause button, right? Nobody's going to want to do that because it's a very big risk. So understanding that if the increased borrowing costs now have come down a bit, people are jumping in. We're not seeing enough jump in yet. That's a concern that I have. So as billions in CRE loans are coming due, we need more people to jump into this and see these opportunities, take advantage of it. That's developing and advancing these communities. Moving onward to a market reset, we're going to see that a lot of market resets within just loans start shifting where the money's flow. So i.e., if you had property and you're a baby boomer and now you just sold 5 properties and you got yourself $20 million, where's that money going? Is that going into real estate? Is that going into stock market? Is that going into private equity? Where is it going? And that's huge because these loans come due and that money shifts from one to the next. Trend number 3, let's dive into it. Multifamily. The heat is back on, baby. And that's what we're talking about. I've been waiting for this for a while. What happens? Multifamilies become a little bit more attractive when those debt rates go down. Those debt rates going down means more people will buy and sell. It also allows you to understand where we were and where we're going. So in the news, you're going to see a lot of rents are stabilizing, demand's rising, and investors are returning. It's a perception theory. If you think perceiving wise that you're the last one in the game, you're going to want to jump in. And if you see other people and you're around the barbecue campfire, and you're talking about a story, your success story in real estate. I want you to know that many of them have told it about buying a 6, 10, 20, 50 unit building and holding it for 5, 10 plus years. The rents go up, you renovate it, you make a lot of money. Now, it's an easy theory and simple, yes, but it's hard to execute. So I'm gonna encourage you that the old Chinese philosophy statement of when do you plant a tree? 25 years ago. When's the next time you plant a tree? Today. So I'm gonna encourage you that don't worry about numbers of the past, worry about numbers of where you're going in the future. If you're betting on that, you see these historical trends, you'll know it's a safe asset, you can buy it, it's competitive, you're building this for longer term wealth. Now, sometimes you get huge short-term gains, right? Those are those great stories and we see them on Instagram or here and there. Don't count on that. What I want you to count on is just a process that can work, and that means understanding. Rents rise, debt's paid down, you hold it long enough, creates that gap. That gap is called cash, it's called equity, called whatever you want in terms of it, business, new business, taking care of your college fund, taking care of your daughter's startup, AI business, whatever. What does it mean to you? It means people need housing. We're shortage on housing right now, all throughout the United States. I'm a firm believer and I'm on a mission to make sure we advance our communities to the point where we have enough housing. Because understanding that the trends of housing as you build more and it gets competitive, the pricing starts to stabilize because you have healthy competition. In our area, if a property's built, they're so infrequently built that they just command huge premiums. And what does that do? It limits the amount of buyers in the marketplace that are simply looking for that. In our area, a lot of them develop the maximum buildable square footage because that's the way they can get their return. Now, if they don't do that, no houses are built. But if they do that, it caters to a market. So how do we pierce that one hard, thick skull to be able to get more? We start developing. We start bringing brokers into the community to bring these things to life. And what's that opportunity to look for? Value add deals, long-term holds and comebacks. You can find properties, you can make them more beautiful inside, renovate, they're gonna command more rents. And if you do it at scale, instead of 5, you do it 10, expect double the income. That's how simple we're talking here. And also expenses. If you think that you're gonna nominally just increase your expenses, no, it's proportionate to the amount. So project properly. And if you've never done it before, get somebody that has. Talk with them, partner with them, work with us. You'll have a formula for success, a proven system that works. Trend number 4, developers are not building enough. Am I talking about this? Yes, because it's the truth of what the marketplace is. When we start going into constructions in decline in terms of the amount of plans and approvals, we start seeing why. We start seeing the amount of bureaucracy, the amount of resistance, the amount of unknown becomes there. We found a way to simplify this solution for every individual that's looking at developing that's above grade. I think that we'd have much better housing product, difference in the way that it's streetscaped, and also communities that are built within the people that can buy. We don't have to overbuild to build the biggest and most expensive homes. We can build in that submarkets and still make money. And that's what I'm also encouraging all throughout, which is why I love townhouses, which is why I love product that can deliver to communities. So if it's not a single family house, at least you have the feel of that, with some amenities, being able to get out of your apartment, being able to see the community, but also having a private time, being able to work, all these different things. That's what we care about. And that's where that ESG that comes into play with environmental, social, and governing. If you don't understand, developers deal with this. They have to be environmentally friendly. People are not approving plans that don't have that environmental friendly aspect to it. It's as simple as that. So follow that, otherwise you're gonna get resistance. Social, if you don't have certain things that the towns want that are mixing within, i.e. a retail space on the ground so that people can walk by with the apartments above, or maybe they have to have certain entrances and keeping single families in mind, and then having the townhouses, or a difference of making sure that they have governing resources like a school in a bigger community or fire, and all these different things. That's what I'm talking about for ESG. Impact on reduced building is going to be very costly because it decreases the amount of housing around. If we decrease that, supply-demand theory is very simple. If we don't have enough supply and we have a high demand, pricing is just going to continue to go up. With inflation being pretty much stabilized right now. Housing pricing not necessarily going up in all sectors, but in our sector, it's so damn competitive that people are seeing it. So commercial markets, if it's priced right, it's selling. And if it's not, well, you're gonna get an owner user, hopefully that can pay that, or a 1031 buyer, and that's what we see. Otherwise, it's dirt to dollars when we look at the development potential. That's what we're diving into. So overdeveloping is not where we're at. Right now, we're underdeveloped and we need to develop. So future opportunities. Shortage of new housing in the future will likely lead to higher rents, increasing the value of already entitled land. So when you understand that the markets are shifting, land's getting more valuable, you could create economics around housing that has equity, properties that have equity where you can build JV with owners or sell it to them yourselves and still create that value. Okay? What is not being built today will become more expensive tomorrow. And I lead with that on the end of this slide because that's the truth. What is not being built today will be more expensive tomorrow. Know that fact, understand, jump into the markets, especially commercially. We were selling buildings where people were buying these things at $100 a foot, $1 million. We're selling them now less than 5 years later, $3 million. Where else do you make that in the market? Not sure. But these buildings, if you get ahead of the curve and you know the vision, you can be one of those people too. So jump on it. Trend number 5. Big money, baby. It's waiting. A lot of private capital on the markets are on the sidelines, they're on the shelf, they're not going through what we would configure the life cycle of money. Not everyone's putting it back in real estate. Stock market averaging 9, 10, 11% over the past 10 years. Where can I buy it in real estate and get a higher return? You gotta go private. You gotta understand syndicating funds, coming together, going at scale. Because if you can leverage the money, that money on an IRR basis, internal rate of return, and cash on cash, significantly increases. So think of it like this. If I can buy a $1 million property, put $100,000 down, that property goes to 1.5 million, I just 5x my investment cash on cash. But if I put $500,000 down on $1 million, it goes to $1.5 million, I just made the same exact amount of money. So instead of 5xing it, I made that 100%. That's the difference in leverage. 5x on something simple as that. Guys, billions in reserve. Private equity firms are sitting on the market. Get calls all the time with, where do we see opportunity? And that's what they want to see, because in 3, 5, 7 years, when those private equity funds start unfolding and paying back all their shareholders, they're going to want that return. So where do they see opportunity? You can align yourself, private equity firm or somebody outside of it that could strategize alongside with us bringing them there. Maybe that's an opportunity for you to untap. Selling properties, developing properties. Opportunity knocks, guys. When big money's on the sideline, they're going to look for where to inject it into the market. If they see trends and you're on the side of the trends and you know that the industrial sector is transacting 3 times as high as every other sector, multifamilies chugging away to try to get up there too, you'll realize that if you find yourself in the mix of the ones that transact more, you'll have more opportunity. The ones that transact less, if you see that, could create opportunity, but it may take longer. And it's also going to be like having something that's an outlier. Now, it doesn't mean that you don't get the one-off that sells the Pokemon card for $16 million. Of course, it's possible. But if you bet on that and it doesn't happen, this entry level, you can get wiped away. So don't do that to yourself. Make sure we're opportunity knocks. And remember, you're the deal source. Guys, everyone that we have, when we're the first door entering into a property to sell, that means we have the first vision and the eyes on the property. That means we can position it to the people that we think would be best to fit that seller. Now, it's never a one and done. We never want to just say, oh, we got one buyer. No, we have tons. We expose it. We want to make sure that we give competitive tension. And that's huge. Because when big money's waiting and they see that, we can add a little competitive tension. You'll flush out the offers that were not real, bring people to the top that are. That's a better transaction. Guys, money follows opportunities, not just headlines. So if you create an opportunity, your niche in business, you sell specific product, you work with certain items specifically, understand where your opportunity is to then be able to take capital and inject it in your business with your specialty. And that's what we're doing here, just growing our land development division every single day to make it more systemized, to make it more repetitive and duplicatable as a business, so that we can understand where our offers go out and what's received back and how do we fit that in alignment with our customers. Moving ahead, in real estate, the people who wait for clarity miss the opportunity. The people who understand historic value shifts win. This is as true as ever. If you are no smarter than anyone else and you bought a property 5 years ago, you are so ahead of the curve, it's not even funny. Person that overanalyzed it with a pencil and a calculator and said this is this and this and this that didn't buy for the last 3 to 5 years missed out on every bit of the person that was so simple and just knew these historic trends. Buy real estate, you hold it, tenants pay the debt down, you make more money. Simple as that. CRE Rewired is about weekly trends, teaching and empowering property owners, real estate agents that want to jump into commercial that are in the residential field. And it's also for you savvy commercial brokers to sharpen your sword and understand what's going on from our perspective. And that's something that we use and we implement into the marketplace every single day. If you're looking for a top-notch broker that delivers the 3-step valuation system, hire an ERG teammate today. Myself would love to untap the value in your property, especially with our dirt to dollars trademark valuation. That's what we have today for Real Estate Rewired. We are rocking and rolling in every aspect. Encourage you to comment below, like, subscribe our video. We're growing our channel and we need awesome people like you to do that. Thanks for tuning in.